Hello and welcome to another episode. So today we're actually going to be talking about diversification versus going all in. What we're going to do today is we're going to look at why some investors diversify their portfolios while others go all in. We'll also look at why financial advisors, traders, and analysts they all recommend diversification while the likes of Warren Buffett, Michael Burry, and these other big traders tend to go all in a particular stock. So, when we speak about diversification, we actually are talking about splitting up the risk. So, what that really means is that the traditional saying of don't put all your eggs in one basket is really what diversification is. So, for example, let's say that you have $1,000 to invest in the stock market. Now, you have one or two options. You can invest that $1,000 into one stock, or you can actually invest that $1,000 into two stocks. So, let's look at Nvidia, for instance. So, Nvidia actually had was at when the stock split occurred was at $120. Now, if you had gone all in and invested at $1,000 and you were to sell it today and it's valued at $140, you'd have made actually $20 on your stock. And so, if you were to diversify and put $500 into Nvidia and put $500 into another stock, then you would have only have made that $40 per share on $500 rather than on that actual $1,000. So diversification is a great option to have, and it's also very relevant in the stock market. So the whole purpose and reason of diversifying your portfolio is to really eliminate or mitigate as much risk as possible. And so what that means is that when you're investing in the stock market, it is very volatile. The stock market can change in an instant without you actually knowing or calculating for that rapid change. And so with diversification, you would have been protected against this change. So if you had invested in a particular stock and for some unforeseen reasons or uncontrollable reasons that stock decided to fall, then if you were diversified, you would have only had that exposure of that amount of money that you would have had invested in that one stock. Whereas if you went all in, then the profits that you would have anticipated or been going after would have been a lot less, or you probably would also be making a loss on capital as well too. So when we speak about going all in now when we talk about going all in, that really is just putting everything in that one particular stock. Persons who usually go all in are highly confident as to what's happening in the market, what's happening with that stock, with the plans that's happening. And so by going all in, you're saying, I am accepting all risk. I am leaving myself vulnerable. I am exposing myself to just this one particular company. And the reason why it's great to go all in is that if your calculations are correct, so you did your necessary research and you spoke with your advisors and you decided on a particular company to head into and you like the direction that that company is going in, by going all in on that one stock now, if that stock should meet or exceed your expectations, then the returns will also be shown to you, and so you would have been experiencing those exponential growth in terms of the stocks, and so you'd have been able to multiply your funds very quickly. The negative to that though is that when you go all in on a stock, if it changes the direction from what you had originally planned for, so if you invest in the company and something occurred that you had not planned for, let's say for example COVID-19 came, so you invested before COVID and COVID came, then that stock would have taken a very big hit. And then depending on the sector that you're invested in as well too, certain stocks are severely sensitive to external market happenings. And so by going all in, you are able to really multiply your earnings, but you're also multiplying your losses. And so if you decide to go all into a stock, then a tip to have is to actually set your price floors and your price ceilings, and also set your take profits and your stop losses. So that way, if the stock should go in the opposite direction from what you originally had planned, then you'd have been protected. You'd have only lost what you would have set to be lost. Now, when you talk about going all in, you have to look at the godfather of investing, Warren Buffett. Warren Buffett is the type of person who really, when you speak about stock trading and investing, he is the standard for investing and trading. And it goes without saying, because Warren Buffett, when he invests, he doesn't really think about diversifying that much. He goes all in. And when you have a company that's invested billions of dollars, you want to do your necessary calculations, you want to do your necessary analysis on the companies. You want to get involved, you want to know what their plans are for the short term, the medium term, the long term, what the plans are in the pipeline, and also what the company is doing at this particular point in time. And so Warren Buffett has stuck true to going all in, because he says that if he invests in a company, his real objective is never to sell the company. So he's investing with the mindset that he is going to hold on to this company for eternity. And so that really says a lot. That speaks about the confidence that he has in the company, and just how much he stands behind it, how much risk he is willing to take. Now, during the COVID-19 pandemic, when there actually was talks of a recession back in 2020, and a lot was happening in the US markets, and they also were on the verge of defaulting on their government debt for the first time. Everyone paid attention, because Warren Buffett had actually started purchasing into certain sectors, so he had actually increased his earnings and his holdings in the real estate sector. And Michael Burry, on the other hand, who is known for The Big Short, and he was known mainly for the shorting that he did during the 2008 financial crash. He actually started shorting the Nasdaq and the S&P indexes. And so he had shorted these indexes for a long time, about 2 years. And then eventually he decided not to short it anymore, and he just closed his positions on all of this. So the reason why I'm speaking about this is that they both decided to go all in. They just took different strategies in terms of how they did it. So Michael Burry was going all in against the market, while Warren Buffett went all in favor of the market. So he was going on sectors which he believed would actually grow once everything would have been over and finished. And so as we wrap up, when it comes on to diversification, if you're very new to the stock market, if you're new to investing, then by all means you should diversify your portfolio. And a good way to diversify your portfolio is to start with index funds. I know index funds are great because it gives you exposure to the entire index. And if you are seasoned in the market and you want to really multiply your returns, then by all means, if you are willing to accept that risk, then you can go all in on the stock. And so that's all that I wanted to talk about today. So thank you guys so much for tuning into this video. I hope you did enjoy it. If you did, I ask that you just give us a thumbs up or like it wherever you see this video. Leave any comments or reviews down below, and I will be more than happy to get in touch with you. And subscribe if you have not yet done so to the channel, so that you do not miss out on any new videos as soon as they are released. Take care and love you guys always. Until next time, bye.